Hi, my name's Eric. I'll be reading you selections from Barron's magazine with an issue date of April 27th of 2026. It's produced by the Audible Local Ledger, a reading service exclusively for people who are blind or print disabled. We'll start with up and down Wall Street. The highest paid CEO of 2025 is a furniture salesman. This is reported by Andy Serwer. CEO pay makes no sense. Look at Tim Cook, the recently announced, soon-to-be departing head of Apple, who had received a cumulative $2,396,887,967 in compensation since becoming CEO in August of 2011, according to research firm Equilar. Is it right that a non-founder CEO ends up with billions? Well, when Cook succeeded Steve Jobs, Apple's market capitalization was $349 billion. Today, it stands at $4 trillion. Apple's market cap gained $3.6 trillion under Captain Cook's steady hand. His total pay of some $2.4 billion, a mere 0.0655% of that market cap gain. I'm more of the mind to praise Cook than to bury him. But my point isn't how tiny that percentage is, but rather its arbitrariness. Could Cook's pay have been double that amount? And how do we know what the right amount is? With CEO pay, questions beget more questions. One irrefutable truth is that CEO pay immutably rises, and never more so than last year, according to Equilar, which reports that the median annual pay of large company CEOs hit $29,422,666, a record high, up 23.2% from 2024, versus a more typical 10% increase. 5 CEOs landed 9-figure pay packages last year, versus just 1 in 2024. Equilar ranked the largest CEO pay packages at companies with 2025 revenue of at least $1 billion, based on their most recently filed proxies to the Securities and Exchange Commission as of March 31st. Some context. Median total return to shareholders last year for those companies was 20%, which was in the same ballpark as the rise in CEO pay. Corporate profits as a percentage of U.S. gross domestic product hit a record high in the fourth quarter of 2025, according to the Federal Reserve Bank of St. Louis. Still, board comp committees wouldn't have known that. So why were CEOs paid so much in 2025? Some of it may have to do with artificial intelligence, says Amit Batish, Equilar's Senior Director of Content. Companies want to retain CEOs in a period of transition like this, and companies like Broadcom, Ralph Lauren, and Danaher have actual AI implementation goals in comp plans. There are basically 2 kinds of CEOs topping these lists. First are the evergreens, CEOs who run the biggest companies in the world, many with strong shareholder returns, whose boards feel compelled to pay them tens of millions in compensation. Examples are Satya Nadella of Microsoft, $96.5 million last year, Hock Tan of Broadcom with $205.3 million, and Tim Cook, $74.3 million. The second group are the one-offs, CEOs who land one-time mega pay packages, popping up in the rankings never to appear again. The highest paid CEO last year, Niraj Shah, CEO of Boston-based Wayfair, an online purveyor of furniture and home goods, appears to fall into this camp. Shah was awarded a $280,847,068 pay package, 98.89% of which came in the form of performance stock units, realized only if he remains CEO, and Wayfair's stock appreciates by 675% over the next decade. That would put the stock at $630.93 versus its recent price of $81.41. His cash compensation, which includes perks, amounts to $289,568. Wayfair was a COVID-era darling, soaring in the first half of 2020 from $21 a share to $342, then falling back to $24 last spring. And as we said, it's now trading at $80. Shah, who co-founded and controls the company with Cornell classmate Steve Conine, has been its CEO since inception. The award reinforces our commitment to the founder-led leadership of CEO Niraj Shah and to long-term alignment with shareholders, a company spokesperson told Barron's. As for the capriciousness of this world, consider that the CEO of the company with the worst total return to shareholders on the list last year was Shantanu Narayan, the long-standing head of Adobe. Narayan had been a rock star CEO, but his stock got SAS-pocalypsed and fell 38% in 2025. That doesn't match up well with Narayan's $51.1 million, some $20 million more than the CEO with the best shareholders' return on the list. That title belongs to Kevin Hochman of Brinker International, which owns and operates the red-hot restaurant chain Chili's Grill and Bar, as well as Maggiano's Little Italy, a total of 1,600 restaurants in 29 countries. Its stock was up 149%. And he received a mere $30.4 million. Then there's the ratio of CEO pay to that of the average worker, a bugaboo of Bernie Sanders, which also continues to violate the laws of gravity. That us versus them metric has more than doubled since 2017, from 152 to 341. Should the government step in, as Sanders has proposed, to quench the trend? Doubtless many of you would think that to be a gross overstep, trusting in free markets or laissez-faire. The latter phrase comes from French thinkers in the 18th century, including one Marquis d'Argenson, who in 1751 called government interference detestable. It's true that excesses do seem to get worked out, though sometimes with unintended consequences. Luckily for the Marquis, he didn't live to see how Robespierre and his Committee of Public Safety worked things out in the Reign of Terror some 40 years later. To that point, note another item climbing inexorably these days: average expenditure on CEO security, up 136% since 2021 to $130,428. Seems like some CEOs are looking to head off an off with their heads moment. The Streetwise column is next. It's written by Jack Huff. Big Food's fat dividends. Which ones are safe? Big food stocks have been hit so hard that I saw Mr. Peanut asking Count Chocula about tax loss harvesting. Kraft Heinz is down more than 40% over the past 3 years, not counting dividends, and General Mills, Campbell's, and Conagra brands are on 60% apiece. The S&P 500 over that stretch made 72% plus dividends. As prices have fallen, dividend yields for the bunch have plumped up to 7 to 9%. To quote Kool-Aid Man, who I hear is investing for income these days, oh yeah. But he should think carefully before barreling in. There are several challenges facing these companies, and one could soon get a lot worse. Food companies face cost inflation, stretched budgets for middle-income shoppers, and competition from small insurgent brands. Plus, market share in grocery is shifting toward mass merchants that can play hardball on price. State Street Consumer Staples Select Sector SPDR, an ETF that holds all of the above food names, has eked out a gain over the past 3 years, largely because its two largest holdings, Walmart and Costco Wholesale, are up 160% and 100% respectively. To these headwinds, add weight loss shots, and now pills from the same companies, with one approved in December and another only in April. The medicines are old news, but UBS argues in a recent report that adoption of them is just getting started. About 1% of U.S. adults currently use this class of drugs, commonly called GLP-1s, after a hormone produced in the gut. That'll hit 10% by 2030, says UBS, as prices come down and insurance coverage and availability spreads. Studies suggest that GLP-1 users eat and drink some 30% less, although declines are obviously not evenly distributed. Booze gets hit harder than sparkling water. UBS reckons the aggregate hit to food and beverage demand will be front-loaded, a 1.2% decline this year, followed by 0.9% next year and 0.3% in each of the following 2 years. The report comes from the bank's packaging analysts. They expect GLP-1s to negatively impact companies like OI Glass and Graphic Packaging, with exposure to beer and snacks, respectively. But it might just help a player like Avery Dennison, which makes RFID tags for clothing. We can infer a difficult stretch for big food, too. And in a separate analysis, B of A Securities points out that dividends for some food names look stretched. There are many ways to judge that sort of thing, like comparing payments with earnings and free cash flow, and with companies' target dividend policies. It's important to factor in debt levels, looming maturities, and credit ratings, and what ratings agencies say about where things are trading. B of A uses all of these. What isn't particularly helpful usually is management commentary on dividends. A payment cut, or even a whiff that one is likely, can send shares sharply lower. So companies often say they're strongly committed to their dividends until the day they cut them. B of A uses a traffic light scale to measure its level of concern over cuts. Its red light stocks are Conagra, Kraft Heinz, General Mills, and Campbell's. Yellow lights are Hormel Foods, Mondelez, Hershey, Lamb Weston, and McCormick, which has agreed to combine with Unilever. In better shape, at least dividend-wise, according to B of A, are the green lights, Smithfield Foods, J.M. Smucker, Tyson Foods, and Utz brands. I've never gone on one of those self-discovery trips where an Amazonian shaman administers hallucinogenic brew made from the ayahuasca vine. But I did overshare here recently about my atomic fireball habit, and while they're usually individually wrapped, I found a packet with 2 the other day, so I doubled up. During the deep introspection that followed, a spirit guide whispered into my ear, "Are psychedelic stocks overpriced?" I didn't answer. I have a hard enough time figuring out momentum stocks in this dimension. But he might have been on to something. Shares of Atai Beckley, which is testing a nasal spray with an ayahuasca ingredient for depression, are up 212% in a year. Compass Pathways, which is also working on depression with a lab-made compound of psilocybin, the stuff found naturally in magic mushrooms, is up 134%. And Definium Therapeutics, which is in late-stage trials for LSD-based pills to treat depression and anxiety, and looking into whether a form of the party drug Molly can help with autism, is up 283%. Together, these 3 companies are valued at close to $6 billion, factoring in potential share dilution. None has meaningful revenue, but there are high hopes for closer to the end of the decade. Oppenheimer is bullish. There's a new White House push to accelerate clinical reviews, and many of these medicines are aimed at patients for whom other treatments have failed, including military veterans who suffer from PTSD. But there is a long history of recreational drugs falling short on promised medical breakthroughs. A decade ago, cannabis, which has long been used medically, for example, to ease nausea in chemotherapy patients, was the subject of a drug development hype wave, and money poured into new stock listings and exchange-traded funds. This past week, the government reclassified cannabis as a less dangerous drug. But treatments have been few, and stock losses profound. Holders of cannabis ETF with a ticker WEED are down 74% in a decade. Another ticker, MJ, has lost 87%. Consider pot's drop before piling into psychedelics. A 2023 study of psychedelic medical research found myriad problems, including very small sample sizes, selection bias, placebo effects, and a lack of control groups. Heard of Mrs. Winslow's soothing syrup for teething infants? Or Godfrey's cordial for women with nerves? These 19th century patent medicines worked a treat for pain relief and calming. But their active ingredients, morphine and opium, brought other problems. We're a long ways from those incautious days, but that doesn't mean that future psychedelic cash flows will support today's stock highs. In a look back at the week past and a look forward at the week to come, we're at the review and preview section of Barron's with an issue date of April 27th. Scoring the Cook era. Steve Jobs and Tim Cook left very different legacies as Apple CEOs. Jobs introduced iconic products, while Cook strategized ways to make them generate big shareholder returns. Apple said this past week Cook will step down as CEO in September, replaced by hardware engineering chief John Ternus. Jobs formed Apple with Steve Wozniak and Ronald Wayne in 1976. Jobs left, returned as interim CEO in 1997, then permanent CEO in 2000. Under Jobs, Apple launched culturally defining products, including the iPod, the iMac, the iPad, and the big one, the iPhone. During Jobs' CEO tenure, Apple stock surged 6,759%, according to Dow Jones market data, with sales increasing 21.5% annually. Cook became CEO in 2011. Apple's stock rose 1,932% in his nearly 15 years as CEO, compared with 504% for the S&P 500. That trailed Jobs, though Cook took over a much more successful company than Jobs had. In that same period, Samsung Electronics rose 1,415%, Lenovo Group 126%, and HP Inc. 71%. Under Cook, Apple sales annually increased 10%, and earnings per share 16%. Apple was the first U.S. company to top a series of market capitalizations. $1 trillion in August 2018, $2 trillion in August of 2020, $3 trillion in June of 2023. The stock now has a market cap of $4 trillion. NVIDIA got there first. Cook also led the charge into services, launching Apple Pay in 2014 and Apple Music in 2015. Services is now its highest margin business. That was reported by Angela Palumbo. Last week, in markets, hopes for peace in the Iran war receded after a 3-week market rally. Oil rose again as Iran said it would close the Strait of Hormuz until the U.S. lifted its blockade. President Trump threatened not to extend the Wednesday ceasefire deadline and then extended it indefinitely. With talks on pause, stocks retreated and then rallied on chip earnings. On Friday, the Department of Justice ended its investigation into Federal Reserve Chair Jerome Powell, paving the way for Kevin Warsh to be confirmed. On the week, the Dow Industrials fell 0.4%, the S&P 500 rose 0.5%, and the Nasdaq Composite gained 1.9%, both closing at new highs. In companies, Tim Cook stepped down as CEO at Apple. Hardware chief John Ternus replaced him. The administration neared a $500 million rescue package for Spirit Airlines. Amazon.com said that it would invest $5 billion in Anthropic, which will buy $100 billion of Amazon cloud services. Tesla upped its 2026 capital spending to over $25 billion. Intel beat on earnings and offered a strong outlook. In deals, Brad Jacobs QXO agreed to buy insulation maker TopBuild for $17 billion. SpaceX secured an option for code editing startup Cursor for $60 billion, but not until after it goes public. And Bloomberg said Deutsche Telekom was mulling a full merger with its 53% owned T-Mobile US. Amazon-backed X Energy rose 27% on its initial public offering. This week, on Monday, April 27th, about a third of S&P 500 index companies report results this week, including 5 of the Magnificent Seven. Verizon Communications releases earnings on Monday, followed by Coca-Cola, T-Mobile, and Visa on Tuesday. AbbVie, Alphabet, Amazon.com, Meta Platforms, Microsoft, and Qualcomm announced quarterly results on Wednesday, while Apple, Caterpillar, Eli Lilly, MasterCard, and Merck do the same on Thursday. Chevron and ExxonMobil report their earnings on Friday. On Wednesday, April 29th, the Federal Open Market Committee announces its monetary policy decision. The FOMC is widely expected to keep the federal funds rate unchanged at 3.5% to 3.75%. This could be Fed Chair Jerome Powell's last meeting at the helm of the Fed if his nominated successor, Kevin Warsh, is confirmed by the Senate before the mid-June meeting. By the numbers, 97%. That's the percentage of the southeast U.S. that's suffering from spring drought conditions. 16.9%. Urban youth unemployment in China in March, with 12.7 million graduates set to enter the workforce. 63%. That's the increase in American applications for Irish citizenship based on ancestry in 2025, which is a record. 66%. The surge in battery electric vehicle registrations in Germany this March over March of 2025. On to the Tech Trader section, and as you can imagine, it's all about Apple in tech this week. Apple got the CEO it wants, the stock gets the one it needs. This is written by Adam Levine. As Tim Cook exits the CEO role, Apple remains the most important consumer electronics company in the world. At last count, the company had roughly 2.5 billion devices in use worldwide. Cook has brilliantly used that base to build a services business with $109 billion in fiscal 2025 sales. But Cook's astounding management of Apple's growth has moved Apple a little off its North Star, which is the user experience. It's a philosophy Steve Jobs laid out during a raucous interview with skeptical developers at the 1997 Worldwide Developers Conference, his first after returning to Apple. You've got to start with the customer experience and work backward to the technology, he said. You can't start with the technology and try to figure out whether you're going to try to sell it. But Apple, in recent years, has drifted off that singular focus with its so-called liquid glass interface. That's especially unpopular on the Mac. Meanwhile, ads are coming soon to Maps. Not exactly a user-first idea. The Apple of today needs someone with that same Jobsian laser focus on user experience. Someone just like John Ternus, who was named CEO this past week. Ternus worked his way up the hardware design ladder at Apple over a quarter century and is best known for leading the shockingly smooth transition of Macs from Intel chips to Apple's own custom designs. In September, he'll be running the company, with Cook as executive chairman, engaging with policymakers around the world, quote unquote. Cook is freeing up Ternus from 3 of the most challenging tasks facing an Apple CEO: dealing with Donald Trump, China's Xi Jinping, and India's Narendra Modi. Ternus gets to stay squarely fixed on what makes Apple great: an unparalleled user experience where the devices, software, and services work in harmony. So, what does the next 15 years look like for Apple? Besides the usual painstaking design choices every year for its existing products, Ternus has 2 big challenges at the top of his agenda. The immediate one is making Apple Intelligence into something that users really want to use. Apple's approach to artificial intelligence got off on the wrong foot in 2024. The crucial feature, a conversational Siri that lives up to Apple's standards of quality, security, and privacy, still hasn't been implemented. After trying and failing with its fully in-house approach, Apple's leaning on its longtime search partner, Google, to provide the back-end technology for the next generation of Siri. We should hear more about the implementation at WWDC 2026 in June, 29 years after Jobs first defined Apple's approach. But Apple Intelligence hints at a more distant threat to Apple, one that will fall on Ternus's plate should he be lucky enough to match Cook's CEO tenure. The touchscreen smartphone turns 20 in a year. Just as the smartphone supplanted PCs as people's main computing device, someday something will replace it. Might be smart glasses or something else wearable. For now, ideas are converging around a new human interface that will eventually replace the decades-old graphical approach and feature conversations with Siri supplanting mouse clicks and finger taps. In 2026, Apple needs a product guy at the top, because in the long term he'll be in charge of building new devices with Apple Intelligence central to the experience. I have a long history with Apple. My first Apple device was an Apple II Plus in 1981 when I was 14 years old. My father persuaded my mother to buy it for me by telling her that I would never again want anything so badly. And so far he's been right. I bought my first share of Apple stock soon thereafter. I've been a pretty continuous fan since Jobs' 1997 return, especially after his public appearances in 2005 and 2006 convinced me that an Apple smartphone was imminent. I sold my Apple stock and every other individual security before I joined Barron's staff in 2024, but I remain an ardent bull. Yes, the high growth days are probably behind Apple. It's a mature company now, with products in mature categories. At a 30 price-to-earnings ratio for the next 12 months, near the top of Apple's historical range, the stock is hardly cheap. But Apple is also the rare big tech stock that isn't reshaping its cash flow and balance sheet with AI investments. While Amazon.com, Meta Platforms, Microsoft, and Alphabet's Google spend $100 billion plus a year on chips from NVIDIA and others, Apple's keeping its powder dry. And with Ternus aboard, I'm more confident that Apple has a new iPhone-size category up its sleeve, even if it takes years to materialize. Most importantly, the signal from Ternus's elevation to CEO is that Apple will remain focused on the user experience, which is what keeps it an essential company and an essential part of my tech portfolio. On to the articles in Barron's of April 27th. Berkshire beckons investors once again. Warren Buffett found plenty of stock buys over the years, and right now, his company looks like one. By Andrew Barry. Berkshire Hathaway stock has gone from expensive to cheap over the past year. At its current price, not a lot has to go right for this trillion-dollar conglomerate to generate market-beating returns, even without Warren Buffett at the helm. Berkshire has a capable manager in Greg Abel as CEO, earnings power of about $50 billion annually, a stock repurchase program in place that might total $50 billion this year, and $373 billion in cash on its balance sheet to make new investments. The stock is in the midst of one of its worst periods of underperformance relative to the S&P 500 since Buffett took control of Berkshire in 1965. The Class A shares are down 7% this year to $705,000, while the Class B shares are off a similar percentage to $469. The S&P 500 index has returned about 5% so far in 2026. The gap is more glaring over the past year, with Berkshire down about 13% since it peaked on May 2nd of 2025. That was the final trading day before the Berkshire annual meeting when Buffett surprised everybody by announcing he would step down as CEO at year-end in favor of Berkshire executive Greg Abel while remaining chairman. The S&P 500 has returned 27% since then, a gap of 40 percentage points over Berkshire. The current price offers a good entry point for investors and potentially allows the company to repurchase a lot of stock. The stock's weakness appears to reflect a few factors: the disappearance of any Buffett premium, a wait-and-see attitude toward Abel, lackluster revenue trends, and doubts about whether Abel will be able to deploy much of Berkshire's cash. These are legitimate issues, but they appear to be reflected, and then some, in Berkshire's stock price. Investor Christopher Davis of Hudson Value Partners, no relation to the Berkshire board member with the same name, says investors this year are gravitating to so-called halo stocks, heavy assets, low obsolescence, like Caterpillar, amid concerns about disruptions caused by artificial intelligence. But they're ignoring one of the best plays, Berkshire. Berkshire is the ultimate halo company, given the durability and inflation protection of the insurance business and the very hard-to-replicate industrial operating businesses, he says. Berkshire owns Burlington Northern Santa Fe, one of the two largest railroads in North America, Berkshire Hathaway Energy, one of the country's biggest electric utilities, and a slew of industrial businesses. Davis calls the stock a coiled spring at the current price. UBS analyst Brian Meredith also is a fan, telling Barron's the stock is attractively priced relative to intrinsic value and also defensive, given its diversified earnings power and huge cash position. The business fundamentals are fine, but not phenomenal, he says. There's room, he says, for Abel to improve performance at key divisions like BNSF and Berkshire Hathaway Energy. Both lag behind peers in key profit measures. Meredith has a buy rating and a price target of $871,000 on the A shares, nearly 25% above current levels. Berkshire resumed its share repurchase program on March 4th, after a nearly 2-year hiatus, and bought over $200 million of stock that day, Barron calculates based on information in the Berkshire proxy. With the shares down 3% since then, the company may have continued or accelerated that program. The company will detail its first quarter share repurchases and probably those in the first 3 weeks of April in its next 10Q report. That filing and Berkshire's first quarter earnings releases are due on May 2nd, the date of the annual meeting. The stock now trades for less than 1.4 times our estimate of the company's first quarter book value of about $505,000 per Class A share, against 1.8 times a year ago, which was near the highs of the past 25 years. The current price-to-book ratio is below the average of the past 3 years. Buffett doesn't reveal his intrinsic value estimate. Longtime Berkshire watcher Chris Bloomstrand of Semper Augustus Investments' intrinsic value estimate is $855,000 per share, 21% above the current stock price. Bloomstrand sees Berkshire stock as capable of generating about 10% annual returns over the next decade, driven by growth in book value. Berkshire isn't as cheap when it's valued at 23 times projected 2026 earnings, as the analyst consensus has it. But the company's carrying a lot of low-yielding cash and investments on its balance sheet. Adjust for those factors, and the effective price-to-earnings ratio is lower, roughly in the high teens. There's room for improvement in operations and investments. Operating revenues were flat at Berkshire last year, says Kathy Seifert, an analyst at CFRA. I'd like to see Greg Abel confront the issues and outline a plan for profit and revenue improvement. Abel may also need to address how he plans to deploy Berkshire's huge cash position. In a mild surprise, Abel is asserting control over virtually all of Berkshire's $300 billion equity portfolio. Ted Weschler, a longtime Berkshire manager, is getting authority over just 6% of it, up from 5% when Buffett was CEO. Buffett had originally envisioned Weschler and Todd Combs running the entire equity portfolio under the oversight of Buffett's successor as CEO. Combs left Berkshire in December for an investment job at J.P. Morgan Chase. Abel, however, has no formal experience as a portfolio manager and is fully engaged on the operations side. He should hire more investment talent and give Weschler more authority. Berkshire's 13-member board of directors, including 2 of Buffett's 3 children, has long been deferential to Buffett and could use stronger independent members now that Buffett's no longer CEO. One great addition would be Apple CEO Tim Cook, who's set to leave the top job in September while remaining chairman. Buffett admires him, and Cook could bring stature and tech savvy to a company that isn't a leader in employing technology. Berkshire's in better shape than its stock price suggests. For long-term investors, betting on Berkshire should pay off, even after a legendary investor passes from the scene. The next article is titled 3 Things That Could Turn Crypto Around. Digital assets have lost some 25% since President Trump took office. Congress and regulators could rewrite their fate, by Joe Light. President Donald Trump's pledge to make the U.S. the crypto capital of the world isn't going as planned, but cryptocurrency investors shouldn't throw in the towel just yet. A series of catalysts in Congress, at regulatory agencies, and in geopolitics could soon combine to lift the price of digital assets. The crypto market hasn't had many wins lately. Right now, investors are focused on the fate of the so-called Clarity Act. The crypto regulation bill, one of the White House's priorities, would cement many goals the industry has long championed, but it's been stalled in the Senate for months. Passage has gone from a foregone conclusion early in the year to a long shot, even as lawmakers hope to hold a committee vote in the next month. Perhaps the most jarring surprise for crypto fans is that the most pro-crypto president the market could hope for has done little to help prices. Since Trump took office, Bitcoin has sunk 25% to about $78,400. Ether, the second largest cryptocurrency, is down 29%, while some so-called altcoins like XRP and Solana have been halved. It's not what people expected, that's for sure, says Ron Hammond, head of policy and advocacy at Wintermute, a crypto market maker. A lot of people thought we were going to the moon here, and we'd be at $250,000 Bitcoin. Obviously, that's not the case. Trump promised to make America the crypto capital on the campaign trail, and the White House put that plan into action days after he took office. The Security and Exchange Commission and Department of Justice dropped or settled dozens of actions against firms, including trading platforms Coinbase Global and Binance. Administration appointees from the venture capital and crypto community helped coordinate industry-friendly moves across the administration, including an executive order to create a strategic reserve of Bitcoin and other cryptos. So far, none of those moves has been enough to end Bitcoin's prolonged bear market. But there are reasons to think crypto's luck might soon turn around. The first, but least likely catalyst could come in the next month, if the Senate manages to move the Clarity Act with votes from both Republicans and Democrats. The bill would put most trading under the purview of the Commodity Futures Trading Commission rather than the SEC, a long-desired industry goal. Removing ambiguity around how crypto is regulated would make it easier for institutional investors to buy digital assets, and for traditional finance firms such as banks to offer their own crypto products. The bill's been stalled since January, amid a skirmish between crypto firms and banks, which want the bill to include a prohibition on the payment of yields on stablecoins, a kind of cryptocurrency that's typically pegged to the dollar. Senator Tom Tillis, a Republican from North Carolina, has said he hopes soon to release the text of a compromise, but bank trade groups have indicated they might still oppose it. The bill has hurdles beyond the yield issue. Trump has substantial investments in digital assets firms, and many Democrats want the final version to ban him and his family from profiting from crypto. The bill's biggest enemy is the calendar. Congress has limited time before campaign season for the November midterm elections ramps up, and other must-pass bills to address before moving on to crypto. It's likely the Senate Banking Committee will pass the bill sometime in May or June, but if it can't get Democratic votes, that would prevent it from becoming law. We aren't in the danger zone yet, but we'll need to see this bill moving by June, says Beacon Policy Advisors analyst Chris Niebuhr. The yield issue is continuing to chew up the clock. Good news for crypto investors is that, in lieu of a bill, the Trump administration is trying to make it easier in other ways for the industry to flourish. In the next few weeks, the SEC is expected to unveil innovation exemptions that could allow firms to launch pilot programs for stock trading on blockchains and other experiments to merge the worlds of traditional and decentralized finance. The SEC also released a token taxonomy in March, clarifying that it didn't believe most crypto transactions fell under its jurisdiction. A future administration could reverse it. That could be increasingly unlikely if consumers and businesses delve deeper into crypto, similar to what happened with rideshare services. Tokenization is already happening. It's inevitable, Hammond says. Patrick Witt, who helps lead Trump's crypto efforts, said at a conference earlier this month that the White House might also provide more details in coming months around the Bitcoin reserve, which could drive prices higher. The White House didn't respond to a request for comment. The strongest reason for optimism is that many of the headwinds that dampened prices over the past 6 months are finally starting to ease. In 2025, a wave of digital asset treasury companies issued stock to buy Bitcoin, driving its price to a peak of $126,000 in October. That source of demand has since faded, and the market only now seems to be getting over the hangover, says Stephanie Ouellette, CEO of crypto firm FRNT Financial. Crypto has suffered with other risky assets because of the Iran war and higher for longer interest rates. The start of peace talks in April helped Bitcoin rise 14% this month, though prices are still down 12% this year. Prices will keep rising as clouds dissipate, and even during the downturn, the improved regulatory outlook has encouraged more institutions to expand into crypto, Ouellette says. There are announcements that now happen every day that if they happened in 2019, the market would go up 20%, he says. Bitcoin doesn't need more reasons to go higher. Investors just need a lack of reasons to sell. On to another subject, currently very much on financial people's minds. Private credit faces its run or reprieve reckoning. As the funds begin to report, investors may finally get a sense of the size of the problem. By Bill Alpert. After enduring a near bank run in recent weeks, private credit is about to lay more cards on the table. We should have a better idea in a few weeks if the industry will regain favor or remain under a cloud. It wasn't long ago that private credit was the place to be, if you had the money and the right wealth advisors. But too much cash poured into the sector. Credit funds began making less profitable loans, and questions arose about loan quality. Last month, wealthy investors mobbed the exits. Now investors are wondering if the bank run is over. We'll find out in the next few weeks as credit fund managers such as Ares Management and Blue Owl Capital report first quarter earnings. Among other topics, they'll undoubtedly spend a lot of time talking about fundraising. The federal government recently permitted retirement plans, including the $14 trillion target date fund industry, to begin holding private credit with stocks and bonds. But will these new inflows offset redemptions by wealthy investors? Over the long run, the private credit industry might well benefit from less money. Most private credit loans go to companies bought by private equity, but the pace of buyouts hasn't kept up with the money pouring into credit funds. To invest it all, funds ease their lending terms. The industry itself has said as much. The shift toward gathering client funds intended to be immediately deployed rather than patiently invested has led to structural under-earning and looser protections on assets across the sector, says managers of 6th Street Specialty Lending, a publicly traded private credit fund organized as a business development company, or a BDC. The result is what we see today, a BDC sector going through an intense yet warranted reset. The private credit industry emerged in the wake of the 2008 financial crisis to fill lending gaps left by then cauterized commercial banks. Publicly traded BDCs like Ares Capital and Blue Owl Capital supplied credit for private equity buyouts, in place of broadly syndicated loans that were arranged by banks. Some of those listed BDCs grew large, but a much larger amount piled into non-traded BDCs marketed through banks and brokers to institutions and wealthy individuals. The credit funds boosted their returns by leveraging investors' funds through borrowing. Their profits mainly came from the spread between the interest they paid on those borrowings and the higher rates they charged on floating rate loans to their corporate borrowers. Exuberance seized the sector in 2023 and 24, when the Federal Reserve raised interest rates. Yields on private credit portfolios climbed to 12% for the best secured first lien loans. Dividends grew so fat that BDCs stashed some profits in rainy day surplus accounts. The yields of those peak credit years helped non-traded BDCs grow assets by more than $150 billion between 23 and 2025, according to With Intelligence researchers at S&P Global. At the same time, other varieties of credit funds, such as interval funds, grew assets by another $150 billion. Fund managers had to quickly deploy all that money into loans to meet tax rules and generate fees for themselves or for shareholders of publicly traded management companies like Blackstone, Apollo Global Management, Ares, and Blue Owl. And that's when the spreads began to shrink. As funds competed to lend, they allowed more borrowers to defer cash interest payments by adding a period's interest to the loan amount as payments in kind. They also let spreads on first lien loans slip from nearly 6% in 2023 to 5% by 2025. Portfolio yields and profit coverage of dividend payouts fell more steeply as the base rate underlying the floating rate loans dropped with the Fed cutting rates. From a 2023 peak of 12%, the average yield on a first lien loan fell below 10% by 2025, and then dividend payouts started to decline. News reports about wealthy investors' disenchantment have focused on particular bad loans, or the threat of artificial intelligence to the fund's software industry borrowers. On Thursday, the Wall Street Journal reported that regulators across several federal agencies were examining private credit firm disclosures and valuations for their loans. The BDCs insist their loans are solid, but narrowed spreads and dividend cuts may be reason enough for some investors to want out. Nearly every non-traded BDC saw March quarter redemption requests swell above the 5% of net assets that managers prepare for. Requests jumped to 22% and 41% respectively at non-traded Blue Owl Credit Income and Blue Owl Tech Income funds. Redemptions at the industry's biggest non-traded fund, the $86 billion in assets Blackstone Private Credit Fund, or BCRED, came in at 7%. As one of the first managers to report, Blackstone said this past Thursday that BCRED's March quarter net return was flat. Its outflows came from a relatively few large accounts, the firm said, with most individual investors staying put. Institutional investors continue to commit large-scale capital to private credit, said Blackstone CEO Stephen Schwartzman. As credit funds move past March redemptions, industry bulls are celebrating what they see as an industry reprieve, if not a return to favor. In quarterly earnings calls, big bank critics like J.P. Morgan Chase CEO Jamie Dimon seem to walk back their past cautions on private credit's vitality. Even steeply discounted stocks of listed BDCs have recovered some of their lost valuations. Even if wealthy investors continue to seek the exits, a new wave of individual money could be coming, and then we'll see how private credit spreads hold up in the face of that new capital. The final article, in Barron's of April 27th, insurers are linked to embattled private funds. Athene, MassMutual, and other insurers hold nearly $16 billion in bonds from the private credit funds that have faced heavy redemption requests, by Jacob Edelman. Worries about private credit have shaken financial markets in recent months, following years of surging growth for the industry. A new Barron's analysis shows that even the sleepy annuity and life insurance sector might not be safe from those concerns. Insurers led by Athene and MassMutual hold nearly $16 billion in bonds against funds managed by Cliffwater, Blue Owl Capital, Blackstone, and others hit with over-the-limit redemption requests so far this year, Barron's found. Recent outflows of capital from these private credit funds could make those loans riskier than once thought, adding a new layer of uncertainty for policyholders expecting life or annuity payouts. An Athene spokesperson said its holdings of such bonds represent less than 2% of its total portfolio. The investment-grade bonds have performed well over time and generated strong risk-adjusted returns, reflecting our ability to invest with discipline across asset classes and sectors, the spokesperson said. MassMutual declined to comment. Last month, Moody's downgraded its industry-wide outlook for business development companies, or BDCs, a sector that includes most of the private credit funds, to negative from stable, citing the redemption requests by retail investors as a major factor. The rating firm separately downgraded its outlook for Blue Owl Credit Income, the recipient of $1.9 billion in lending by insurers, to negative. S&P Global Ratings dropped its outlook from stable to negative for Cliffwater Corporate Lending, which has borrowed almost $6 billion from insurers, the most among funds hit with redemption requests beyond their quarterly limits. Blue Owl said in an April 2nd letter to shareholders that the redemption requests come from a small portion of shareholders, and that its fund is well positioned to navigate a more volatile market environment. Cliffwater Chief Investment Officer Blake Nesbitt said on social media last month that its fund has outperformed its peers, while charging lower fees. The asset managers did not reply to requests for comment from Barron's. Nearly all insurer exposure to those funds is through loans, putting them ahead of the equity-holding retail investors if a vehicle fails. Gillian Froment, Executive Vice President and General Counsel for the American Council of Life Insurers, said life insurers invest for the long term, lining up those investments with the long-term promises they make to policyholders. Day-to-day market swings usually aren't a concern, she said, and with non-traded BDCs, features like limits on withdrawals make it much less likely you'd see sudden run scenarios that could cause major disruption. But if investors remain skittish about the funds and redemptions continue to outpace new fundraising, the capital-starved vehicles could eventually threaten bondholders as well, says veteran asset management executive Mark Goldberg. There are second-order effects when liquidity demands exceed net inflow, and that ultimately could impact these loans, says Goldberg, who writes about private credit funds on the website Alternative Investments Market Intelligence. Insurers have been lenders to 9 separate funds that were hit with the large redemption requests. The funds also includes vehicles managed by Morgan Stanley, BlackRock, Ares Management, MassMutual-owned Barings, and Apollo Global Management, Athene's parent, according to Barron's analysis of data provided by the National Association of Insurance Commissioners. While loans to the 9 funds accounted for a tiny fraction of any insurer's total assets, the exposure is the latest example of the insurance industry's growing appetite for investments beyond its traditional diet of corporate bonds and government debt, as they seek higher returns. Insurance group Advantage Capital Management has faced regulatory action and a recent downgrade by the insurance industry's main ratings firm after missteps connected to loans supporting sports teams, budget airlines, and other assets with unpredictable returns. Advantage Capital's CEO Kenneth King said he was happy to have this period of uncertainty behind us after state insurance regulators ceased their actions. The company didn't respond to a request for comment about the downgrade from ratings firm AM Best. Insurers have also been sued for transferring assets to affiliated businesses in overseas jurisdictions where they're allowed to carry thinner cash buffers. The loans to private credit firms are an example of an industry practice that could spook annuity policyholders expecting stable returns from their savings, says Eileen Applebaum, co-director of the Center for Economic and Policy Research, a center-left think tank. They put it into an annuity that will be there for the rest of their lives, no matter what, she says. And now that steady stream of income they were counting on is being invested in risky things. Assets of non-traded business development companies, the dominant vehicle for selling private credit to retail investors, have grown 145% over the past 2 years, expanding from about $114 billion at the end of 2023 to $280 billion, according to Fitch Ratings data, covering 20 of the largest such funds. Since early this year, private credit has come under fresh scrutiny, largely because of loans to artificial intelligence-threatened software firms, as well as recently collapsed companies like First Brands and Tricolor. Those business failures led J.P. Morgan CEO Jamie Dimon to warn of more cockroaches in the system that could imperil private credit. Even with most funds enforcing their stated quarterly limits on investor withdrawals, that's known as gating, many investors redeem their holdings of non-traded BDCs faster than managers could sell new shares during the first quarter of 2026, Fitch wrote in a separate report. Managers of these funds and some analysts say the funds remain on a strong footing, with institutional investors, such as insurers, remaining confident in the vehicles. In a report last month, analysts with Morningstar DBRS said investors should ignore the noise. The fund's overseers manage significant institutional capital, which generally exhibits less volatile asset flows, the analyst wrote. Apollo President Jim Zelter said during an appearance on Bloomberg TV that the public has really lost the plot on the private credit funds. We're talking about a little bit of a skirmish on the sidelines here, he said. Insurers are weeks away from having to report their first quarter investment activity to state regulators, so it isn't known whether their exposure to the private credit funds has changed during the redemption surge by retail investors. Barron's asked each insurer whether they had changed their approach to private credit lending in recent months. All either broadly declined to respond to questions from Barron's or said they don't comment on investment strategies. The biggest lender among life insurers to funds that have faced over-limit redemption requests in 2025 was Athene, followed by MassMutual, American General, Security Benefit, and Commonwealth Annuity, according to Barron's analysis. Athene's $4.8 billion in private credit fund bond holdings are dominated by loans to private equity firms that are rivals to its parent, Apollo. Among insurers, Athene is the biggest lender to Blackstone Private Credit Fund, with nearly $1.3 billion in those bonds on its books. And with that, we've come to the end of our reading of Barron's Magazine, which has an issue date of April 27th, 2026. This is your reader, Eric, saying be well, be safe, look after each other. Bye for now.